Advanced Financial Modeling, Topic 6, Forwards and Futures, Learning Objective number 3. We're going to compute forward payoffs and simulate hedged and unhedged cash flows. So let's talk about the cash flows or payoffs to a forward contract. Remember, each forward contract has two counterparties that sign the contract. You have the buyer of the asset, called the long party, and the seller of the asset that delivers the asset, that's called the short party. Now the forward, we call the buyer, takes delivery of the quantity Q of the asset and pays the forward price. We'll call it F0. The buyer's payoff is the difference between that forward price F0 and the spot price at delivery. We'll call it ST. The buyer is said to have a long position in the forward since she profits if the spot price at maturity is above the forward price. So she profits if the prices go up. So we can just write the payoff function for the asset buyer in the forward contract. That is ST, the spot price at maturity, minus F0, the agreed upon forward price at the beginning of the contract, and the times the quantity. And you can think about how the profit is actually realized. If the buyer has to buy at F0, they can immediately then sell it in the marketplace at maturity at ST times the quantity. So that's their payoff. Now the seller has the opposite payoff. The seller is called the short party of the contract and profits if the spot price falls below the forward price. So we say the short or the seller has a payoff of F minus ST times Q. Now remember, this is the seller of the asset, so they're going to receive F0, that's why it's positive. How they could profit from the position is they can go out in the marketplace at maturity of the contract and buy at the spot price ST and then deliver at the agreed upon F0 and earn profit. So those are the payoffs. Long, ST minus F times Q. Short, F minus ST times Q. So now we can talk about hedging with forward contracts. If you own an asset and want to guarantee a price to sell it in the future, you could short a forward, or we say sell a forward. Now, in reality, all you're doing is you're signing a contract and you agree to be the seller and lock into that forward price. So examples of short forward contract people would be ranchers that are trying to guarantee the price of beef, miners trying to guarantee the price of gold, exporters trying to guarantee the price of a foreign exchange, energy companies trying to guarantee the price of oil, or investors trying to guarantee the price of an individual stock or bond. Now, if you buy an asset and want to guarantee a price to, if you need to buy an asset and want to guarantee a price to buy it in the future, you could go long the forward, or we say buy a forward, even though you're not buying a forward, you're just entering into a contract to be the buyer. And examples of hedgers that use long forwards or buy forwards are airlines trying to buy jet fuel, restaurants trying to buy beef, cell phone manufacturers trying to buy gold to put in the cell phone, importers trying to buy foreign exchange, investors trying to buy stocks or bonds, industrial firms trying to buy fuel, and say Hershey or Starbucks trying to buy cocoa or coffee beans. So these are examples of buyers of a forward. So let's do an example of Southwest Airlines trying to hedge jet fuel prices. Suppose Southwest Airlines would like to hedge the cost of 150 million gallons of jet fuel in 1 year and an expected cost of $2.65. Now, where that came from is, we'll say that the spot price today of jet fuel is $2.50 and it's expected to appreciate by 6%. So they're expecting it to be $2.65 next year. Now, their expected cost of purchasing 150 million gallons at $2.65 is $397.5 million. I'll show that as a negative since it's a cost. So Southwest would like to estimate what is the distribution of fuel cost based on both quantity and price risk. In other words, how much more or less could they pay for fuel price, given that prices may vary and quantity may vary? And what if they provide this information about the distribution of the fuel prices and the quantity they're going to need? What if they say that they expect fuel prices to appreciate by 6% with a standard deviation of appreciation of 20% based on historical data, and we'll assume normal distributions. And they say they expect to buy 150 million with a standard deviation of 5 million. And again, that might be based on either they're just estimates or based on historical data. So what we're going to do is we're going to build a Monte Carlo simulation to compute the expected cost of fuel, get the, say, 5% highest and lowest cost of fuel, and the standard deviation of fuel cost for Southwest. So we are going to go to the spreadsheet. And what we have here are parameters I've entered already. 150 million quantity. You always want to show purchases as a negative number to show a negative cost, or negative number as a cost. This current spot price is 250. Expected appreciation is 6%, and you can see there that they expect to pay 165 next year. That's just the 250 times 1.06 times 150 million gallons. And if I just take the expected price times the expected quantity, they expect to spend $397 million in jet fuel. So, however, things are never going to turn out to be like expected. There's going to always be some volatility. So we're going to model that volatility, try to see what the range of possible prices or costs could be. So we're going to assume that price distributions are normally distributed. The 1 year volatility, standard deviation of a price appreciation is 20%. We'll assume that normal quantities are normally distributed with a standard deviation of 5 million. So what we're going to do is we're going to simulate the price, simulate the quantity, multiply those two together, and then you have a simulated cost of fuel. So the simulated quantity is they expect 150 million. So I have a link to that 150 plus, we're going to create a random number, norm S inverse rand, times the standard deviation of 5 million. So now it is 150 million, that's what A2 is, plus norm S inverse rand of 5 million. So now every time, if I'm going to take a look at those numbers, every time I hit F9, you're always getting a number around 150 million, maybe between 130 to 170 million roughly. So you can kind of see that's the random distribution. If I were to graph all these numbers, you would get a normal distribution, the normal bell-shaped distribution that's centered around 150, and 68% of the time is plus or minus 1 standard deviation. So it would be around 145 to 155. So you can see a lot of numbers between 145 and 155. And then we're going to simulate spot price. So the spot price we're going to use is 250 times 1 plus the appreciation, 6%, plus norm S inverse rand. That's the random normally distributed standard number, times the standard deviation of appreciation. Oh, let me check on my brackets here. Oops, misspelled norm. There we go. So you can again look at this formula here. It's the 250 times 1 plus the appreciation plus a random z times the 20%. And that should be A9. There we go. So if I hit, I'll put that up again. Every time I hit F9, I get a new random norm S inverse rand. And then you can see there's a lot of prices around 265. But there's quite a lot of variability because it's plus or minus 20, the standard deviation is 20%. So if I were to graph all these numbers here, you would see a center at 265. That would be the peak of the bell, and a lot of 68% of the time, it's plus or minus 20% of that value. All right, so now we have a simulated price, a simulated quantity. I can just multiply the simulated price times the simulated quantity. Looks like I got 397 there. Now every time I hit F9, I get a possible cost of fuel 1 year from now for Southwest. So if I were to graph that, you would think there'd be a lot of numbers centered around 397 million. But you can see numbers as low as 200 million there, and there's numbers as high as 500 or 600 million. So that is the risk for Southwest. And if they're selling flights a year in advance, the customers are locking into a price, so they may want to hedge costs. All right, so what we want to do first is simulate the unhedged cost to get an idea how bad things could get. So to do that, what we're going to do is we're going to run a simulation. And what we're going to do is I'm going to run a macro that takes the unhedged cost that we just calculated and copies it, say, 10,000 times. And then I can take a look and say, what's the 5% lowest? What's the 5% highest? What is the mean of that distribution? So that's what we're going to do. We're going to take that unhedged cost that we have in the cell we just completed. We're going to use this macro, which should be in your workbook, called sub Southwest. And what it's going to do, it's going to take whatever's in this cell and put it in this one, then this one, then this one, then this one. And every time it puts it in there, it recalcs and gets two new random numbers. So let's go take a look. Notice I'm going to put it in this cell right here, and I've hidden a bunch of rows here just so I can see the first two and the last two random costs. Let's take a look at our module. And there it is, sub Southwest. And let's go ahead and run that. Alt F8, run Southwest. I got a countdown there. Notice it. You see the first two costs here. Looks like mine turned out to be negative, or 366 million cost and 345. But it's generating 10,000 of those, and it's going to take a little while. I'll take a little pause and we'll let that run. Okay, as this is finishing up, you can see that we have the 10,000 iterations are completed, and what you see is the mean is 295, just like we would expect it, but we don't run the distribution to get the mean. It's actually about 396, and we expected 397. The standard deviation is $76 million, so you can say I expect 395 with a standard deviation of $76 million. The 5% highest is, in negative number terms, is 270. However, really, their 5% lowest number, which is their highest cost, is about $522 million. So why do we do this? Well, given the volatility of the quantity and volatility of the price, this company would like to know how much more they might have to pay for fuel cost. And we determined that there's a 5% chance they would have to pay $522, which is over $120 million more than expected. So what could they do about that? Well, they could choose to have an extra, say, $120, $150 million in capital just in case those costs come up, or they can choose to hedge using a forward contract. So the next part, we're going to talk about hedging. But let's go back to the spreadsheet here and talk about how I calculated these metrics here. Notice that the mean is just an average of the 10,000 iterations. The standard deviation is just the standard deviation of the 10,000 iterations. The 5% highest uses the large function and picks the 5% of 10,000, the 500th largest number in that 10,000. And then this one is the 5% smallest. Okay, so that gives you an idea how I calculated these distributions. What we can talk about when we talk about this range, you can say that this is the 90% confidence interval. Since 5% of the time you'll pay 520 or more, and 5% of the time you'll take 270 or less, you can say you're 90% confident that the cost will be between 270 and $522 million. So now we're going to move on to estimating the hedged cost. All right. A little note, however, let me just talk about when I do simulations using a standard deviation, I could do the standard deviation on dollars or percents. So when I simulated the quantity risk, I defined the standard deviation of the quantity as $5 million. Okay, so we just did the simulation that it's 150 million plus a random z times $5 million. However, I could have done that in percent terms. 5 million is 3% of $150 million. So I could have written it this way, 150 million times, well, I don't have an expected appreciation there, but I could have just added a random z times 0.05. So it could have been 1 plus that. So all I'm saying is I estimated the standard deviation in dollar terms for quantity, but I could have made it a percentage and did 150 million times 1 plus a random z times the percentage. On the price risk, I did do it on percentage. If you remember the formula we used, that it was the spot price times the expected appreciation, 1 plus 0.06 plus that random z times 20% standard deviation, which is just how I did stock price simulations before. However, you could say that 20% of 265 is 50 cents. So I could have simulated that it's 250 times 1.06 plus a random z times 50 cents, and you get the exact same results as we did before. So the standard deviation could be in dollars, could be in percents, depending on which one it is. You just got to make sure you use the right formula. If it's a percent, it's always going to be it's going to be like a growth number. It's the current spot price or current value times 1 plus a random z times the standard deviation, because it's a percent change. Okay. So Southwest is going to enter into a long forward contract at a price of 267. Say there's a bank out there willing to enter into a forward contract at 267 to cover 100% of the expected quantity. So all 150 million gallons. Now, how's this forward contract going to work? Well, they're going to have this contract, and if the spot price goes above 267, they're going to get paid. Since they negotiated 267, they're going to get paid when anytime the spot price goes above that, and anytime the spot price winds up below 267, they pay. So that's how the hedge is going to work. Is when prices are high, they're going to get paid, and when prices are low, they get paid. Now, what we're going to do is then we're going to go ahead and run this simulation and of the payoff of the forward, and then what the hedged cost is going to be is that unhedged number we just calculated in the last section plus the payoff of the forward contract. So we'll go back to the spreadsheet, and we're going to simulate or create a formula here that they're going to hedge 100% of the forward, 100% of their quantity. So I'm going to do 100% of 150 million here, and I'm going to make that a positive number, just the way I've modeled it here. So they're going to have a forward contract where the Q is 150 million, and then the simulated payoff for that forward is going to be the forward price they negotiated, 267, minus the simulated spot. This is that simulated number that has that norm S inverse rand in it, times the 150 million. So I'll hit enter. So notice on this random number here, for mine, you can see the simulated price was 217. Remember that the expected price is 265. So in this case, the simulated payoff is going to be $74 million, which is the difference between the 267 and the 217. Now I'm going to, well, let's hit F9 a few more times, take a few more examples. Oops, I got those in the wrong order. Sorry about that. It's ST minus F. ST, where's ST? That is the simulated price minus the 267. I'm glad I made that mistake because I want to show you this. If you read this note right here, the simulated payoff for long is ST minus F times Q. If they're short, it's F minus ST times Q. So let's take a look at the example here. In my example here, the simulated price is 345. So in that state of the world, prices are high, and they get a check for $116 million, which is the difference between 345 and 267. But notice when a simulated price is 228, well, then they have to pay $58 million, but they don't mind paying it because they're going to pay a cheap price for fuel. So what's now calculated the simulated hedge price? I'm going to take the simulated payoff of the forward plus the unhedged simulated cost. So now what this is simulating here is both the unhedged cost plus the payoff of the forward. Now what I'm going to do is run another simulation that simulates this number and puts it down here, and we'll see how that compares to the unhedged position. Hopefully the mean's very similar and the standard deviation falls, and this range of 5% lowest and highest falls too. So let's see if we have a simulation we could use here. So it looks like in my simulation I already have it set up that it's doing one more row or one more piece of data. So I could be able to run that. It's taking whatever's in this cell and putting it down there. So I'm going to run Southwest. And there it goes. The reason why it didn't do it before is because there was just a blank cell in there. And that's one reason why it takes so long, is it's doing both of these at the same time. And by the way, the simulation is also, if you look at the macro, is also taking the simulated price and putting it here, here, here. So it's giving you an idea that the 5% highest and lowest simulated price of fuel is between 181 and 348, with a mean of 265 and a standard deviation of 50 cents. So I'll take a little break here, let that run, and we'll compare the results in a minute. Okay, so this simulation is finishing up, and it's actually rerunning all of the unhedged cost, the hedge cost, and the fuel price. And so let's look at the results. What you see is the expected, and the average cost is a little bit higher. That just comes from the fact that they negotiated a 267 forward price when the expected price was 265. If they had negotiated a 265, those numbers would be about the same. But here's the real value of this hedging. The standard deviation of Southwest cost went from 75 million to 13 million. That's a huge reduction. And if there's no price volatility or quantity volatility, the risk would go away. And you can see the 90% confidence range. It used to be between 274 and 520. Now it's between 378 and 422. So there's a 5% chance. There used to be a 5% chance they could pay from 397 and go to 520. Now it's only as high as 422. So they'd have to hold just a little bit of capital just in case, or a little extra funds just in case the prices are higher. So you can really see the benefits. And let's just take one more look at that macro to see how that worked. You can see that it's for I equal 1 to 10,000, next I. This is the counter. That's doing 10,000 down to 1. This is taking the unhedged cost and putting it into the column B. This is taking the hedge cost and putting it into column C. And this one is actually just taking the simulated price of fuel and putting it into the following column. So that's why all of them are being done within that one macro. All right, so you can really see the advantage of hedging. And this hedging cost them nearly nothing, and they've been able to almost greatly reduce the risk of spending more money to buy fuel. Now, what could I do with this? You could, in this model, if you want to play around with it a little bit, take the standard deviation of the quantity and make that 0. So if you said there's zero chance that the quantity be different, what you'll notice is all these numbers become the same. You eliminate all of your risk. The standard deviation would go to 0. So the fact that we have any risk left is really just because we have quantity uncertainty. And you can also say that many firms only hedge 80% of their 80 to 90% of their exposure. And that's because, well, they maybe the quantity could be much less and they don't want to be on the hook to buy so much fuel. So it's common to do 80 to 90% hedge ratio. And what would make this number would just be a little bit higher. All right. So you can play with the model then, and the firms can determine which level of hedging they'd like to do. So a couple other things I want to talk about before we move on. About 50% of the time, Southwest would have been better off not hedging. In other words, if the price of fuel is normally distributed, it's asymmetric, it could go up or go down. So 50% of the time, the price could be lower than what they're expected. In those cases, you can't say hedging was a bad idea. All right, that's like saying you got auto insurance and any day you don't have a car accident, it was a mistake to buy insurance. These contracts are insurance that guarantees the price of a commodity. So you can't say it was a mistake just because they would have been better off not hedging. Not hedging is speculation that prices will fall. So the fact that you don't hedge, you're taking on risk. What hedging does, it reduces the volatility of profits and allows the company to make plans without fear of consequences of adverse market moves. So that's the real idea. Southwest can work on, say, customer service and marketing and not worry about the prices of jet fuel. So in the next topic, we're going to construct simulations using other distributions besides normal distributions. We're going to talk about uniform distributions and triangular distributions.